You get a set of financial statements from your accountant at the end of the year, and you can pull a set of financial statements, your profit and loss and balance sheet, at any time through the year if you've got a computerised system that's up to date, such as Xero. But what does it mean, and how would I use it to track business performance? So there's a few things that as business advisors we look at when we look at financial statements. Most people kind of look at them and get them from their accountant and go, gee, thanks, and put them in a cupboard. They actually mean something, and it's really important that you do understand what they mean. So the first one is looking at your gross profit, making sure that your cost of sales is not increasing over in time, because it means either that your materials or your wages, whatever your cost is, has gone up, but you haven't passed that money or that increase onto your customers. And if you haven't passed on to your customers, then you're losing out because you're just losing that cost increase. Secondly, we look at your overall operating expenses. We want to have a look at the percentages of turnover that they are for things like advertising, wages, rent, and we want to make sure that they're not increasing massively over time. Sure, advertising can increase from time to time, but usually there's a reason for that, and you've got to measure the return on investment of advertising spend. But that's a whole different topic. So we look at your profit and loss, we look at your profit, your net profit, and make sure that that's going up over time, because if your business is increasing, your turnover's increasing, your margins are good, and your overhead costs stay the same, you should be making more profit. Then we get to your balance sheet. Now, a balance sheet is a snapshot in time of where things were at any particular moment. Things that we look at are your current ratio, which is how much of your current assets you've got to pay your current liabilities. Are your eyes glazing over yet? Current assets are things that you've got that you can cash in quickly. Bank, debtors, stock. Current liabilities are things that you owe in the next 12 months. It might be your suppliers' invoices, might be your GST, your PAYG withholding, and your super. If you're a QBCC client, we also look at the next 12 payments of your car loans or your equipment loans as well. But we want to make sure that current ratio is at least 1-to-1, making sure that you've got enough assets that are liquid to pay the bills that are due. Because if you don't pay your bills when you're due, you're technically insolvent. And that's a scary, scary thought. Then there's a whole heap of other ratios that accountants can look at. I'm not going to go right into them because I could go on for days. It's really your operating profit or net profit, your cost of sales, and your current ratio. The only other thing that we do look at is debtors' turnover days and creditors' turnover days, because it tells us if our debtors are getting slower in paying. We want to make sure that we're moving on them and keeping the cash running through your business. And your creditors' payments, if they're dropping out, then it means that you're taking a long time to pay your creditors, and you need to make sure that you're within their terms, because if you want to try and barter with them for better deals, you need to pay them on time. So that's kind of a snapshot of what financial statements are and how we use them to see how your business is going.